the markets had generally expected this decision. It was a consensus view that he just simply cannot move. Do you agree with it?
Yes, as you can see, it's a lot of sign of relief on the side of the operators, because there has been some concern that with the petroleum subsidy partial removal, there is a lot of temptation for the central bank to want to maybe take, an advanced lead in tightening the system. But I think it's a very good idea to actually watch and see a little bit to see whether the system can actually absorb that movement in prices before coming in with the shock. So I think I totally agree with the central bank on this matter, that yes, it's a good idea to still hold the rates as they were.
How much longer do you think they can take this wait-and-see approach? Because the governor has said that he anticipates inflation to tick up with the shocks of the removal of the petrol subsidy partially, that we could see inflation go as high as 14% in the mid-year of 2012. And so at some point, they're going to have to make some sort of a decision.
Yes, thank you. But I also know that there is a lot of lag in the effect before it trickles down into the system. If you go back a little bit into the theory of ISLM model, where you talk about the money market and talk about the real production cycle, that is roughly like a 3 months lag between those two before one can begin to influence the other. So I suspect that for the whole of the first quarter, I think we should be fine. And by the second quarter, if the palliatives being put in place by government begin to take effect, it may actually begin to ameliorate some of those negative impacts of the movement in rates and inflation upwards. And we may just be able to weather the storm. But if we're able to cross the second quarter without any major hike in terms of prices, then I think we're done. The rest of the year should be able to actually see some moderation, both in terms of exchange rates, interest rates, and to some extent in terms of inflation.
All right, let's continue talking about what we're likely to see by way of temporary shocks. What's going to happen when the inflation rate starts to tick up and then is eventually higher than the actual MPR rate? I mean, that's going to have a definite consequence on the money markets, because yields, which are already inverted, may take a different stance altogether, if that's the right terminology. We may just see bond deals looking less attractive than what they've already been.
Yes, I think I agree with you. Anytime the economy goes into a negative real interest rate, there is a real risk that the central bank authorities may have to do something about interest rates, which naturally will be to take it further up. And the fear for me is that it further crowds out the same private sector that we're all hoping to try to protect. And I think in the report and in the announcement of the results and the rates, we had something about the Senate, looking at increasing the benchmark rate in the budget to about 75 or even 80. We hope that will not happen, because once that happens, it's actually going to give a lot more ammunition and bullets, to inflation rates to begin to go further up. I suspect that between the presidency and the Senate, they will come to some kind of consensus where the rate, the inflationary pressure will not be too much. Right. And I know that the Ministry of Finance, for sure, has been taking a lot of steps to see how they can moderate the expansionary policy in terms of the fiscal side of the business. Before
we talk about what government's responsibility is in ameliorating inflation, let's talk about what you've just mentioned by way of credit flowing to the private sector and rates as they impact on loans to the private sector. We do know that with the removal of the fuel subsidy, prices have risen by about 50%, and it's expected to be much higher. SMEs have really suffered in a high interest rate environment and now in a high price environment. What bearing is all of this going to have on credit flows to the private sector, given, of course, that AMCON has been in the markets and has absorbed a lot of those systemic risks when it comes to credit into the system?
Okay, I'm happy you asked this question, because I've always said that capital will always find the location and the investments that pays the highest return. So I do believe that the private sector still remains the best place to actually invest, because the rate of return, even on government securities, yes, it's high today at with an MPC, MPR of about 12%, and TB is doing about 15%. But an economy like Nigeria, where the expansion is still on the high side, GDP growth is still in the tens if we get all of the infrastructural issues sorted out. So I believe that the private sector still has enough to offer in terms of return on capital. And therefore, there should be no disincentive to lend to the private sector, especially with the cleanup that has already happened with AMCON. And if you go back a little bit into the statistics, you will recall that in the 2011 financial year, in spite of all the cleanup in the system, there was still about 30% or so growth in lending to the private sector. So we expect that in the new financial year, which is 2012, with all the corrections that have taken place, we believe that we may see even a higher growth, maybe 30, 35, right. And I'll just see how it goes, yes.
All right, let's go back now to government and their responsibility. I mean, the governor has always said we can do whatever we need to do by raising interest rates, by mopping up liquidity of Naira in the system, but the government has to play ball. They have to rein in their spending, they have to keep the deficit low, and then, of course, this issue of a new budget for a new year and what you do by setting a benchmark rate for the petrol price. We already know that the proposal is for the petrol price, the benchmark, to be 75 Naira. As you said, that would really have a very negative impact on inflation. The finance minister says she wants to rein in spending. Recurrent expenditure will be capped at 2.7%. But with an infrastructure drive, it's unrealistic to expect the government to not spend more and not widen the deficit.
Well, you see, government has quite a number of options and has a lot of resources to deal with. You will recall that at the beginning of the year, the issue was how to divert what was in petroleum subsidy into infrastructural development and other human development projects. Now, if that is done, even if it is only at 50% at this point, that will already give a lot of room, you know, for some funding to come from other sources. You also recall that there are quite a number of multilateral agencies that are involved with the government in what they are doing. And also there is a lot of private-public sector partnership that is going on now. For example, when you talk about road construction in the economy, there has been a lot of concession that has been in place. I think once things settle and we're able to get financing for those ones outside of government, then the pressure on government to continue to expand fiscal policy spending, will be able to come under control. And for me, really, the issue is about principle and strategy. So once the government has consciously decided that they are going to go that route, I think it's to stay on course and make sure that they deal with the challenges as we encounter them.
I mean, Abdulrahman, knowing the Nigerian government, let's be frank and open and honest here, do you really think they're going to rein in their spending?
Well, we have a brand new government here, so let's give them a chance. Let's see how it goes. I mean, we have Ngozi from the from the World Bank, and I'm sure she has quite a lot of discipline in the business. We have the central bank governor, who has actually been very instrumental in bringing to the fore some of the excesses that we have in the fiscal spending on the other side. So let's see how the two of them collaborate, and let's give them a chance.
Let's talk about the currency. The Naira will be kept constant at 155 Naira within a new equilibrium. But we've seen the Naira weaken a little bit against the dollar. It gained a bit of ground in early Jan, but generally it's been trading on average at 161 Naira to the dollar. The Naira and its stability has been a major issue for the central bank. And right now, interest rates might not be the only way to sort this issue out.
Well, I think exchange rate management, I've always believed that we should go back into the fundamentals. If you use purchasing power parity, for example, to look at the value of the Naira, I don't think it's actually way out. If you use the balance of payment equilibrium approach to also value the Naira, you also see that the corridor of 155 plus or minus 3% should be able to work. I think the fundamentals is to see whether the foreign reserve can continue to support. And I do know that with 33 or 30 billion and above, I think that is sustainable. Now, what goes into that reserve into the future is the issue. And that is why I would have thought that the Senate and the presidency will leave the benchmark for budget for this year at $70 per barrel. And that way, all the excesses in that area between, for example, the current 99 or $100 to that 70 can continue to increase what you have in that reserve and continue to increase the capacity, of the economy to withstand shocks in that market and be able to make it flow. For me, really, whether it is 155 or whether it is 150 or for that matter 160, the issue is not about the absolute figure. It's about the sustainability and about keeping it predictable, so that investors can be able to look at this economy and make some long-term investment, something fairly long, 3 years, 5 years down the line, and be able to say, yes, this is where we're going. And as an industry, we also want to begin to develop some kind of derivatives that begin to protect, investors down the line, to say, look, come rain, come shine, let's give you a forward contract that can at least protect you in the next 2 or 3 years, and then we'll see how it goes. And I think the authorities are also beginning to do the same, because I understand that beyond just banks trying to do that with their customers, even the central bank is beginning to give that support back to the bank to say, you can sell derivatives into the market, and then you can buy it from the central bank as a backup.